Hello, everybody. This is Don Fall with Mercer Partners. We're still having people clicking in. We're going to give another minute or two, and then Chad will be getting us started. So bear with us as we hold out for a couple more to join, and then we'll get going.
You're right. I see the attendee number climbing, so I really appreciate all of you guys joining us this afternoon just to spend a little bit of time on the markets. I see a lot of familiar names that spent time with us at the beginning of the year with our kind of annual investment symposium kickoff. So this is kind of our mid-year check-in, mid-year outlook on the markets. So spending time diving into a lot of the current events, hot topics, headlines that have been driving, a lot of the things that we've been thinking about and the investments underlying those as well. So really thrilled to have our friends at Dimensional with us today. Wes Crill will be presenting and kind of walking us through the first 6 months of the year. So we're thrilled to have them as a partner and on with us today. A couple of logistics or housekeeping items is we will have time for Q&A at the end. So save your questions for the end and we'll be able to unmute you so you can come on and ask your question. We can dive into what's top of mind for you. And then we are also recording. You may have heard that disclosure play at the beginning, but we're recording our webinar as we do with most. So just need to let you guys know that as well. So Don, Nick, and myself, thrilled to have you guys join us and spend some time with us this afternoon. And without further ado, I'll kick it over to Dustin to get us started.
Awesome. Thank you so much, Chad. And thank you all for taking the time to join the session this afternoon. I'm Dustin Weil. I'm a regional director with Dimensional, and it's been my great pleasure to have the opportunity to work with Chad, Don, and Nick over the last several years in supporting all of the great clients that they work with. We've had a long-standing partnership, both Dimensional and Mercer Partners. We feel very fortunate that they choose to work with Dimensional because there's a lot of options out there in the investment management space. So we feel very fortunate that we have the opportunity to work with them and be a piece of your investment portfolios. In our conversation today, we're going to go through, obviously, it's been a very interesting start of the year in markets. There's been a lot of topics and themes that are top of mind for investors. So our goal with our comments today is to provide some perspective. What has been top of mind for investors? And then what do we think about these various questions and themes that have been impacting markets throughout the year? So with me today, we have Wes Crill. Wes is a phenomenal colleague of mine. I really enjoy the opportunity to do these types of sessions because Wes is really what I would say the lead spokesperson for Dimensional in helping to communicate our philosophy on markets and provide perspective around what's going on. He also authors our Above the Fray newsletter, which is a weekly newsletter providing perspective on different topics. He's been a veteran of Dimensional now for 16 years. He was on our research team for over a decade and now serves as a senior client solutions director. So I couldn't think of anybody better to be on the session with us today and present around these different things we've been seeing in the markets and help provide you an understanding of how they impact you as investors. So with that as our introduction, I'll go ahead and hand it over to Wes so he can jump into our comments.
Yeah, thanks, Dustin. Thank you, everyone, for joining today. Hopefully, you guys are able to see the slides I just started sharing on the screen. And, as Dustin mentioned, we're going to do a bit of a grab bag of topics that have been trending lately in our conversations with clients. A lot of the research we do at Dimensional is really targeted at trying to provide perspective on market events. What have we seen when this occurred in the past, or what are some investment implications for the things that we're seeing in the news more recently? And so we're going to touch on a whole bunch of these. One reoccurring theme you'll hopefully noticed during my commentary is the presence of our investment philosophy informing our viewpoint on these events. As many of you would be aware, Dimensional's investment philosophy is deeply rooted in a belief in the power of markets. We believe markets are the best prediction of the future, and they're forward-looking at all times. And so that means that some of the things that we see on the horizon, whether it's macroeconomic changes, geopolitical risks, things like that, to the extent that market participants are aware of them, we believe those are going to be priced in. So that means that the presence of, if it's a concerning, event on the horizon, in and of itself shouldn't, dictate an asset allocation change or some sort of change with your investments. And so, fortunately, this is borne out in the data, as you'll see. I'm going to go through a handful of these topics, and then we're going to open it up for some questions at the end. So this by no means has to be an exhaustive list of all the things that we will talk about today. But these are the ones that I've gotten questions about most frequently. And you can see the list on here. These kind of vary from sort of general observations of what is happening in the marketplace, all the way up to things that I think a lot of investors would consider very concerning when it comes to economic development. So these are in no particular order. We'll just start marching through them. I'm going to start off with this specter of market concentration. This started, well over a decade ago, where the biggest companies in the U.S. market were accounting for a very outsized portion of the market's weight. It's not unusual for the market to be concentrated in a handful of names, but this is really an unprecedented level. I mean, you'd have to go back to the 20s to find a period of time where the top 10 or top 20 companies accounted for so much weight. And you can see on the chart here, this is pretty much a U.S. phenomenon. There's some of this in emerging markets as well. But if you look at the weights accounted for by the top 20 holdings in the U.S., it's close to 50% of the S&P 500, whereas the large cap non-U.S. index is right around 20% and has been very stable. And so certainly this is something that has been increasing over time. And you also see that while the market capitalization weight of some of these companies at the top has been increasing, the percent of the earnings that they account for has really not been that high. We're just as an example here using the Magnificent Seven companies. If you ever forget what all of those companies are, you can summarize their tickers by Tan Mama, which will capture those seven companies. And you can see their market capitalization of just those seven companies is about 19% of the global equity market. It's a very high number for seven companies, but they account for about 12% of the overall market's earnings. And what that tells you is that their valuations are very high. So you have two combined effects here. One is that if you're just focused on U.S. large cap indices, you're going to have a very large chunk in a handful of companies that also have very high valuations. So certainly this has led some investors to think, okay, well, what are some ways that I can mitigate my exposure to these companies? Now, there's no reason to believe necessarily that these market prices are incorrect. That's unknowable in real time, but certainly I just think the optics of having so much weight in a handful of companies is concerning to many investors. So what can you do about it? Well, fortunately, there's a couple of tools in the toolkit that Dimensional's investment solutions can easily satisfy. The first is going international. So if you were to look at, for example, the top 10 companies in the S&P 500, the largest 10 companies there, about 38%. Well, you can see that if you go international, you greatly reduce the weight that's in those companies. The other tool in the toolkit is tilting towards the premiums. So the drivers of expected returns that Dimensional uses to design our portfolios, emphasizing smaller companies, ones with lower price-to-book ratios, ones with higher profitability, those tilts away from the market also decrease the weight in the top companies. So just in the U.S., as we start to emphasize the premiums, DFAU, which is our lightly tilted core equity market ETF, so it's holding the broad U.S. market, it's going to have all those large companies like the Mag 7, many other big familiar large cap names, but you can see that the top 10 only accounts for about a third of the weight of that portfolio compared to 38% for the S&P 500. So you're getting some reduced exposure there. But then by the time you get out to non-U.S. companies, you can see that non-U.S. portfolios, I should say, that the concentration in top 10 holdings is substantially lower. Emerging markets is a little bit higher than developed ex-U.S. So if I look at DFAI, you can see international markets there, only about 10% in the top 10 holdings. So, these are tools in the toolkit for investors if they want to have less exposure to those big companies with really high valuations. These are good ways to do it while still having broad diversification across markets. Okay, so jumping from that topic into the next one, I'm sure nobody's been reading anything about geopolitical risk lately, certainly not with some of the news cycles that we've had. But I think it's always useful to take a step back when you're thinking about things that are concerning to you personally, and maybe even a concern for the economy, not letting it leak over into unnecessary actions in a portfolio, because history has been dotted with very concerning events, and yet stock markets have mostly persevered through these. And I think this gets back to one of my favorite quotes, which is from Calvin Coolidge, so many, many years ago, predated me by a little bit. And he was famous for saying, if you see 10 troubles coming down the road, you can rest assured that 9 of them are going to run into the ditch before they ever reach you. And I think the interpretation of that quote at the time was you shouldn't be too focused on the future at the expense of the present. But I look at it as it's not the stuff that you see coming that's going to impact your portfolio. It's the stuff that you really don't see coming that is likely to impact market prices and, good, bad, or indifferent. And the good news about that is it means that once some sort of development, whether it's geopolitical, whether it's economic, once that's known to market participants, then it's going to be baked into current market prices, which means that even if what I'll call bleak future outlook comes to pass, if that was the market's expectation, you can still have a strong return. So you can see over time the steady rise in financial markets. But we have some good examples where if we just look back historically and say, okay, well, let's say we isolate out all the geopolitical events. This is admittedly subjective. Most of these are armed conflicts, but then you have some stuff in there like Brexit, something that was hitting the news hard. It was concerning to market participants where they might be worried about what this would mean either for the economy or the political environment. And what we did was we took this whole slew of events going all the way back to 1990, and then we said, what did the U.S. stock market do in the period subsequent to this event? Now, if you look in the immediate days after these events, the average U.S. stock market return was actually slightly negative, close to flat, but slightly negative. I look at that as this is the market baking in a change in expectations. If those expectations for the economy, for the political environment have deteriorated, then you would expect markets to go down. But you would also expect that to be really a one-time blip. And sure enough, when you look over longer periods subsequent to the geopolitical events, so 1 month out, 6 months out, by the time you get to 1 year since the original event, you can see that average U.S. market return of about 14%. That's higher than the long run average of the U.S. market return going all the way back to the 20s. So that's showing that markets can and often do move on from these very concerning events. And getting back to the more recent environment, certainly it's not news to anyone that oil prices have been impacted by the latest war. And so, this is something that certainly was a concern earlier in the year. If we look at futures markets, so futures markets are a really great way to get the market's sort of assessment of where prices are likely to go in the future. And if we look at just sort of the futures curves for oil prices, and you can see that on the right side over there, where, okay, if we look back 1 year ago, the expectation for the price of oil at future periods of time was pretty stable. They weren't expecting a war 1 year ago. But then if you look as recently as March, where in the short term, obviously oil prices are not going to magically go back to where they were instantaneously. But you do see a decline there where over the next year, the market seems to expect prices to get closer to their long-term normal. And by the time you get, several years down the line, people are not expecting this to be a multi-year saga, apparently, because oil prices look like they're going to be converging on their long-term average. So, I think this is informative because it tells you a little bit about the market's expectation. But in the interim, we are still going to be stuck with higher oil prices for now. So how much would this impact stock prices? Well, it kind of depends on how much of it was unexpected versus just if you told me we were going to have high oil prices for the foreseeable future, then we would likely expect markets to adjust to this. And they impact businesses in different directions. So if I were to look at the prices of oil stocks in a period of time where oil prices are rising, well, generally speaking, the energy sector has stronger returns in those periods of time. Whereas if I look at, say, manufacturing companies in the manufacturing sector, if their costs go up because energy prices are all of a sudden higher, then maybe their stock prices would decline. But the net effect in a diversified portfolio is likely to be pretty minimal. So we can show that in two different ways here. This is my favorite data visualization technique. You're going to see a lot of this today, unfortunately. It's called a scatter chart. And it's a really simple way to plot out something like the market's return, which is the y-axis or the vertical axis, against the, in the case of the left chart, the contemporaneous oil price. So what was the oil spot price at the beginning of that year, and then what was the return during the course of that year? So on the left side, when you look at returns versus oil price levels, really no relation there. Whether oil prices were good, bad, or indifferent didn't seem to be a strong driver of stock market returns. Over on the right side, instead of the level of oil prices, we're now looking at the year-over-year change. Now, this is going to be contemporaneous. So this is basically saying how much was the change in oil prices during the course of a calendar year, and then what was the stock market's return in that same year. And again, you don't see any strong relation here. If these things were highly correlated, I would expect to see a nice sort of like, upward sloping, actually, probably in this case, downward sloping, depending on your expectation of the relation. But I would expect to see something that was more clustered around a straight line and not just a whole big morass like what we see here. So, this is very consistent with what I mentioned earlier, which is we expect markets to price in as soon as a new information set is known, as soon as expectations have changed for the direction of oil prices. We expect that to get priced in very quickly and for markets to move on and still deliver positive returns on average.
Just one thing I'd add to this is, I think this piece that we went over on the impact of oil prices on the markets, and then the last piece where we touched on just the impact that we've seen historically of some of these very concerning events on the markets. It's understandable that we will be concerned when we see some of these headlines. And we're not saying at Dimensional that you shouldn't have concern about some of these headlines. The most important thing, though, is that you don't let some of these events that are happening at the current time impact your decisions around the allocation of your portfolio. You all are very fortunate to work with phenomenal advisors in Chad, Don, and Nick, and they've put together a very thoughtful portfolio that's diversified. It holds companies in the US, outside of the US, it holds fixed income, and they build that portfolio with the mix that fits your goals and needs. So their portfolio is really built to help shelter you from any of these headlines and the impact it'll have on your ability to achieve your goals. So it's not an issue to be concerned about what we're reading in the newspapers. We just don't want that to cloud our judgment in how we are allocating our portfolios.
Yeah, we often say you don't want to compound your concerns about the state of the world by making adverse decisions with your portfolio. So it's good addition there, Dustin. So from one concerning development to another, we get to government debt. Now, what's funny is, maybe not so funny, but when I started at Dimensional back in 2010, we were coming out of the global financial crisis. There was a lot of sort of quantitative easing that was happening, not just in the US, but around the world. But I remember at the time, it was around 2011, was the first time that the US debt to GDP ratio had crossed 100%. And it was concerning enough to the ratings agencies that was the first time U.S. sovereign debt got downgraded. Now, what was funny was when you looked at the market's perception of the credit risk of the U.S., it didn't budge at all. When we look at something called a credit default swap, we didn't see any change in that spread, even surrounding the event of the downgrade. And so it's not clear the market really learned much. If you look more recently, about 2/3 of the countries that report their debt statistics to the online data sets have debt to GDP ratios over 100%. That's just sort of the state of the world. So you say, okay, well, how big of a deal is this? Well, in many cases, a lot of countries have had high debt levels for decades. Like Belgium, for instance, over the last 49 years, they've had debt to GDP ratios exceeding 100% in 39 of those years. And yet their stock market return over that same stretch is 12%. So it's not exactly the death knell when it comes to financial markets. So we wanted to go and look at what if we were to rank companies into little portfolios and see if there was sort of something we could say systematically about the return differences between high debt versus low debt countries. And so in the top panel here, we're looking at the debt to GDP ratio that's lagged. So this would be an investable strategy, theoretically. You could see what the debt to GDP level was for countries, you rank them into high and low, and then look at their return over the course of the next year. What do you see? Well, you do see a little bit of a return difference in terms of the point estimate, that the high debt countries actually slightly outperform the low debt countries, 13.7% to 11.4%. But There's a row there called T-stat. This is where we test to see, given the statistical noise around stock market returns, are these actually reliable differences in the average returns? Generally, we look at a T-stat of at least 2 as being the threshold for statistical significance. What do we see here? Well, we see a T-stat that's well short of that. So that's basically saying the average returns for high debt and low debt countries are about the same. That's for developed markets. If you look over on the right side in emerging markets, very similar. You get very similar point estimates for the average returns between high debt and low debt. You might say, okay, well, I have a prognostication about where the debt is going to go for a country. Now, debt statistics are very slow moving variables, but stuff can happen. And so if I had perfect foresight over what debt levels were going to be next year, and then I identified countries based on that, what could I say? Even then, I'm not getting statistically reliable differences. You're getting about just shy of 2% for developed markets, but with a puny T-stat, and then emerging markets, short of within 1%, but then, T-stat very small as well. So my takeaway from this is, again, you can be concerned about government debt levels, but it's hard to say how they'll play out for financial markets. And whether we look at credit risk metrics in the marketplace or simple experiments like this, just sorting countries on debt levels, doesn't seem to be a deal breaker for getting a strong return from financial markets. All right. I'm going to jump into inflation here. And again, this is one where I think some of the inflation concerns had died down coming out of the COVID, supply chain disruption of 2022. And then you have a war that causes oil prices to go up. And generally speaking, a lot of things got more expensive. And you again have some more supply chain stuff hitting the news cycle. So if we just look at rolling 12-month consumer price index changes, you see a lot of strong activity on here. Certainly you see that big blip sort of to the far right. That's 2022. And then you see a little bit of a blip over there for more recent periods, but certainly not something that's anywhere close to what we've seen in terms of rising consumer prices. And even when we look at inflation expectations, now you can usually gauge these from certain market indicators. You can use things like break-even inflation, which is the difference between an inflation-protected treasury and a nominal treasury of the same maturity. Or you can also use similarly like inflation swaps that give you a very similar type of information. You can think of it as telling you what is the market's expectation for the average inflation over, in this case, the next 5 years. So it's an interesting indicator. And again, when you look at just this chart here, the big spike that we see is really all the way back in 2022. We don't really see a big run up. In fact, I was looking at this morning. I think the 5-year inflation expectation or the swap rate went from about 2.2% to 2.6%. So a little bit of a tick up, but not anything that suggests we're about to have runaway inflation. All that being said, inflation expectations and inflation reality can and do diverge at times. So on the slide here, we have at the start of each one of these 1-year periods. So we get a calendar year period for each one of these years. And then if you look at what were the expectations at the start of the year for inflation, that's what's in those blue bars. And then what did we actually see during the course of that year for inflation in terms of consumer price changes in the green bars. And you can see a lot of times the green bars are way different than the blue bars, and in some cases much higher. So in 21 and 22, even though the inflation expectations started to creep up by the time we got to 2022, they still didn't keep pace with the actual inflation we got. So there's going to be unexpected inflation. And I think that kind of factors into how you think about dealing with it from an asset allocation standpoint. There's really 2 main ways when it comes to the assets in your portfolio. One of them certainly is to directly hedge that. So you can do that through inflation protected strategies. But there is a cost for that, and nothing is free in life. Everything comes with a trade-off. And in the case of inflation hedge strategies, they're generally going to have lower expected returns than ones that are unhedged that leave you exposed to the risk of inflation. So that just kind of comes down to investors or individual situations. To Dustin's point earlier, that's why you have an excellent advisory team that can kind of help make those decisions. But the other approach here is to outpace inflation. What do I mean by that? Well, most asset classes have had positive average real returns. That means that their returns have exceeded inflation, even in high inflation years. And that's because this is what you would expect, by the way, with a forward-looking market, because whatever inflation expectations are, that's really where the expected return that's being demanded by market participants, that's where it at least has to start, right? Investors demand positive real returns for holding risky assets. So we went back through the historical data and we said, what if you were to divide up all the calendar years for the US, so from 1927 through 2025, divide them into two groups. Years with above median inflation, we're going to call those high inflation years, and then below median inflation or low inflation years. For these high inflation years, what is the average real return for each one of these asset classes? And you have a few fixed income ones at the top, then you have a few different sort of style box market returns for the US. You have sectors, some of the factors that we invest in, for example, SMB, the size factor, HML. Across the board, pretty much everything except for 1 month treasury bills and long dated bonds, government bonds, you can see very strong average returns in some cases, even net of inflation. So, for someone who is not overly concerned with unexpected inflation and just wants to beat it in the long run, you can likely do so just with garden variety equity allocations. Okay. So another one, I can't imagine anyone's heard anything about IPOs lately, and I'm sure what has stoked a lot of the conversation around these is because we all of a sudden have some very massive companies who are IPOing. It's not very common. Most IPOs historically have been small, but one thing to always keep in mind with an IPO is a couple of pragmatic considerations. The first one is that even the IPOs that do especially well, a lot of that return comes from the first day. Unless you feel like you can access these in the primary market before these IPOs start trading in the secondary market, which is very challenging if you don't have an excellent relationship with whatever investment firm is sort of shouldering the IPO and bringing it to market. If you miss out on that first day of return, you likely miss out on a lot of the good performance of even the best IPOs. So that's something to keep in mind. Most investors are not going to get that. The second one is that the total amount of market capitalization that's potentially going to be available in the secondary market is not what you have on the first day. What you see is you'll have lockups for many of the initial investors in the IPO that expire sort of at regimented intervals that occur over time, like every month or over the course of a couple of years. And each time one of these lockup agreements expires, what happens? We have a lot of shares that come to market, which means you have a lot of additional supply for these companies and their stocks. And you don't even need an economics degree to know that if you have an increase in the supply for something, you potentially have a price that's going to drop. So a lot of academic studies have documented a negative price reaction to an increase in the supply from IPOs. One thing we wanted to look at was what happens when the indices add them. A lot of times indices have no sort of considerations around when they add in, these newly minted IPOs, and the returns are not very good. If we just look at average monthly returns for these IPOs after they get added to the Russell 3000, they're not very good. On average, they return about negative 0.75%. That's on the monthly basis. Over that same stretch of time, the index is returning 90 basis points. So strongly underperforming the overall index and really offering a performance drag to the indices that are early adopters there. So at Dimensional, for anyone who's not familiar with our approach, we will generally exclude IPOs for a number of months. It's sort of a case-by-case determination. It's oftentimes been up to a year, depending on what the lockup agreement expiration schedule was. And it's partially because of this underperformance, but also, just not knowing what the liquidity event is going to be when those shares come to market. So for all the hoopla, all the excitement around these companies hitting the market, keep in mind they might not have great returns. And they might not have very great characteristics either. Like the Russell 3000's price to book ratio is about 3. Anyone want to guess what SpaceX's price to book ratio was? That's right, about 17. So much more expensive than the broad US market and a consideration for investors.
Yeah, so we know that these IPOs are, as you would expect, they're large, companies coming to market, so they're capturing a lot of headlines. But you can feel comfortable that your advisor team, by working with Dimensional, we're being very thoughtful around when and how we potentially include these companies. So they're going to be big in the headlines, and investors may think, "Am I missing out by not getting them?" But we can very clearly see by this data. Generally speaking, in the early period, call it around the first year on average, these companies tend to underperform. So you're not necessarily missing out on anything. And then over time, a strategy like one that Dimensional offers we will look to incorporate that when the characteristics of that company meet what we would like to have in our portfolios, and not just like what the indexers are doing today and saying, hey, everyone wants these IPOs like SpaceX. We're going to actually add them very early and not pay attention to things like the lockup periods for investors, the limited supply, and the fact that they generally underperform, which hurts the investors of these index portfolios compared to how Dimensional approaches it.
Okay, so now that we have gotten through IPOs, we're going to touch on our last topic here, and then we can open it up for questions from the audience. And it's around the concept of precious metals. I've never actually done this exercise, but I'm pretty sure if you plotted out the number of Google searches for how do I invest in gold, plotted against gold's trailing 12-month return, you'd have a correlation of 1. Maybe somebody out there can run that experiment sometime. But, we have seen really strong returns from gold prior to the war starting. Gold had been doing fantastically well, well in excess of the broad stock market. But it is worthwhile to point out that that was sort of a blip in what's otherwise a pretty unspectacular track record for gold. If you look at sort of this bottom chart here that just shows the growth of wealth over the long haul, that gives you some perspective on how gold has really not been anywhere near as strong at growing wealth as the broad stock market. So some people might say, okay, well, I don't care as much because gold is going to hedge my risk. You say, okay, well, what risks are we talking about here? If I look back historically, gold has been negative in 40% of calendar years for the U.S. Well, over that same stretch of time, the U.S. stock market's only been down 20% of those calendar years. So it doesn't seem to help you too much on the downside. And then this year has been a reminder that even for the people who are advocating for gold as a hedge against uncertain states of the world, granted, small sample size. I love cherry picking sometimes when it tells my story effectively. But I think this is a good demonstration that in a time when a lot of people were getting very concerned about what was going on in the world, gold was not very helpful. So if we go back to the beginning of the Iran war this year, and then just look at the returns over the course of really the next 2 months. Frankly, these numbers have gotten any worse if we were to look through the end of last month. But if we just look through the next 2 months, the S&P 500 was a great place to be. It had a momentary dip at the start of the war, but then started its ascent again and returned 7.8% over that 2-month span. But if I look at gold, on the other hand, was down by more than 10% since the start of the war. So I think this is something investors always want to be cognizant of. I think this is really the big value of having an advisor to kind of steer you clear of all the shiny objects out there, and always have a rationale for why something belongs in a portfolio. Is it increasing my expected return? Is it helping me manage risk? It's got to check one of those two boxes, presumably. Gold does not increase your expected return compared to risky assets like stocks, and it doesn't seem to be a great risk management tool either. Okay,
Yeah,
so
the
hopefully
point that I would
go ahead.
Oh, sorry, Wes. I was going to add one point on the precious metals topic is that you, through a diversified portfolio and equities, are getting exposure to companies that are mining gold. So you are getting exposure to this area through your portfolio already. So the question becomes, do I need to add additional exposure through direct holdings in silver or gold? And does it actually benefit me as an investor? And as we saw on those numbers historically, these precious metals are very volatile and don't tend to be a good hedge to help you avoid risk like geopolitical risk or other shocks like inflation.
Okay, well, that was what we wanted to cover in terms of the topics that have been on our minds lately. So I'd love to open it up for questions that you guys might have already seen in the chat or anything else you have for us, Chad.
Yeah. So appreciate you guys' comments. Like we said, time for Q&A. So if you have questions, please go ahead and get those over to us. But we'll kind of start to go through some of the general questions we've been hearing a lot of lately in regards to AI. So I'll let you run with AI. A couple of the topics and a couple of slides that you highlighted are kind of AI adjacent. But with all of the talk of AI, AI's role in the markets, an AI bubble, AI changing the workforce, replacing the workforce, all the things that we see in headlines. Where do you see AI moving forward in the markets? Where do you see its pros, its cons, kind of a general as we see in particular, a lot of those the Mag 7, the Tan Mama companies driving the market right now are all very heavily in the AI space. And you just want to give us a general overview of where your thoughts are there with AI.
Yeah, I mean, I don't think it's an overstatement to say the AI is going to be as big of a sea change event for the world as the internet boom was in the late 90s, early 2000s. And, you had basically every type of business was touched in some way by, the development of e-commerce and things like that. And so I think that's probably going to be the case with AI as well. But it's challenging to know who the long-term winners are going to be if it's impacting everybody. And a lot of the early winners in the dot-com explosion ended up petering out as businesses. And if you look at the top 25 contributors to the tech sector in 1999, only one of them of all of those companies had actually outperformed the S&P 500 for the next 20 years. So, Nvidia and some of these other big companies look like early winners. And I think a lot of it is because they delivered unexpectedly good economic results. I mean, the Mag 7 the Tan Mama companies, if you look at their quarterly earnings observations in 2023 and 2024, almost every single observation during that stretch of time exceeded investor expectations. How do we know? Because we can see what the analyst forecasts were, and they kept beating these earnings forecasts over and over. And when you do that, you get really strong returns. But in terms of how it's going to play out in the future, I think it's hard to know. And if you don't know who the winners are going to be, I don't think anyone gets that prediction consistently right. That's why I think it's so important to have a broadly diversified portfolio, because if you look at what a lot of people think is AI, and we have some proxies for this. We can use the Morningstar tag, where they tag things in various smart beta characteristics, and they have one for like AI adjacent type categories. And if you look at the top 5 largest AI based ETFs, their holdings overlap with the broad market by 45%. When I look at that statistic, that tells me that AI probably is like every kind of business out there. But that means if you have a broadly diversified portfolio, you're likely to capture the gains there. So, I think from an asset allocation standpoint, that's the way I think about it. I know for a while there was some excitement that AI tools could be used to pick winners, like use an AI tool to actually assemble your stock portfolio. There's an ETF that's based on the Watson supercomputer. And for anyone who's like, oh, what's the Watson computer? That's the one that won Jeopardy back in the day. It's a very smart machine. And its performance has lagged the S&P 500 by a factor of half. So I'm not sure that that's an avenue I would want to go down either. So it's going to be very exciting, probably change lots of businesses, but I think the best way to capture that is a broadly diversified portfolio.
Yeah, and a point that I would add, I think that people are very hyper focused that AI is only happening within the tech sector, but there are so many exciting developments and ways that companies are leveraging AI. Companies like John Deere, we have companies like Walmart. I always found this was a cool example. Walmart's using AI in their supply chain to help understand if they have produce that is potentially tainted. They can figure out where that produce came from and track down what stores are selling that produce to get it off the shelves and minimize waste, which obviously is helpful to their profitability. So people think, oh, AI is just happening with these large technology names in the US, but AI is having very exciting applications across almost every single sector. So by investing in a broadly diversified portfolio, you are benefiting from all of the interesting ways that these companies are deploying AI in their businesses.
Awesome. Thank you for jumping into the AI question. I know that's a big one flying around. A reminder too, so if you guys have a question, use that raise hand feature at the bottom so we can be sure to address your question while those questions come in. Another kind of just general overview question for you guys. Looking ahead, so the next 6 months of the year, what are the themes? What are kind of the big things that you're watching for, keeping your eye on, big expectations into the next 6 months? We've heard a lot about a new Fed chairman, kind of some of the things now, even today and yesterday, a reignited conflict with Iran. What are the big things that you guys are watching for in terms of themes heading into the next 6 months of the year?
Yeah, I wouldn't say, we don't usually have an outlook in terms of what we think is going to happen with the economy or the Fed or geopolitical conflicts in a way that would sort of impact the way we manage our portfolios. we assess markets every day in terms of our portfolio positioning and what we want to trade in. And a lot of that is just related to how their prices are changing through time. So I think to the extent that there are expected developments along any of those lines, they're likely to express themselves through market prices. And so we rebalance portfolios around that sort of to reflect whatever the market's up-to-date viewpoints are. But, I think the Fed one is interesting because, there's some information you get from, not just like treasury yields, but also you can get it from Fed futures prices. For anyone who has never spent time looking at the CME's Fed Watch tool on their website, it's a great time because you can really see in real time what markets think is the likelihood of the Fed cutting rates in the future. But what's interesting about that is it looked like a virtual certainty in January that we were going to have at least one rate cut before the end of the year. There's a 96% probability attached to it based on Fed's future pricing. And now we have a pretty substantial probability of a rate hike within the next year based on those Fed futures prices. And so, this is informative in terms of our fixed income portfolio positioning. We actually have some research we've been doing on how we can incorporate those Fed futures prices as a way to measure expected returns on the yield curve. But I think it's also a really good signifier, a good example of how market prices are going to have way more of a complete view about what's going to happen in the future. And so we generally won't layer on an economic forecast on top of that.
And going into a year where we're going to have some more elections coming up at the end of the year, just politically speaking, can you kind of add dimensionals color to, the political backdrop of the U.S. that drives or doesn't drive markets?
Yeah, I mean, what drives markets at the end of the day is companies' abilities to be profitable and return cash to investors, and that's a bipartisan objective. Like, I don't think that just because someone is a Republican or a Democrat means that they all of a sudden don't want companies to grow their businesses and make money. So what we see historically is stock market returns have been strongly positive, really no matter who was in the White House. And even some of the effects, like I'll never forget the election in 2020, where if you guys remember, that was when the poll results spilled over into the weekend before they could properly tabulate all of them. It wasn't until Monday where it was formally announced that Biden had won the election. And I was getting ready to go on my first TV interview that day to talk about the insensitivity of markets to political elections. And I looked at what was going on in markets that day, and value stocks were beating growth stocks by the fourth largest amount of any day in history going back to the 20s. I'm like, okay, this shoots a hole in my story I'm about to tell that, markets don't react. Well, it turned out it wasn't probably the election. This is the same day that Moderna released the efficacy results for their COVID-19 vaccine. And they showed that it was very strong. And I think there was a sense of elation because, maybe the light at the end of the tunnel was coming sooner. So, I think that was a good example of how there's just so many things that impact financial markets. And even if you knew exactly what was going to happen with the election, it might not tell you where to place your money.
Yep. Perfect. Yeah, and another thing too that we hear a lot about, and you touched on it a little bit during the presentation with your slide on kind of debt to GDP ratios, is the U.S. debt ceiling, the deficit that we've been running consistently over the handful of years prior. Can you just kind of speak into the debt ceiling, a lot of the headlines that we'll see, not a sustainable, way that the government is currently spending money, that, they're going to correct it this way, that way, that. So can you just speak into a little bit of the debt ceiling and some of the headlines that we see flying around about that?
Yeah, I mean, I think that's why, people are concerned about the overall debt level, not just that it's high now, but it's going to continue to get higher in the future. And, that could be the case. I think that's why it's so comforting to see that historically markets really have not been impacted too strongly in either direction from high debt levels. But if that continues, I mean, certainly there's going to be, as they say, the chickens will come home to roost. Like, there are impacts on the economy. There's also impacts on other marketable securities. Like, if you're crowding out the debt market by, issuing a whole bunch of additional government debt, certainly that can make it harder for companies to secure funding through their debt securities. So, there are potential downstream effects, but I think it's hard to know which ones are going to dominate and when they're going to actually come to pass in terms of their impact on markets. And so, again, it's something that you don't want to miss out on the strong returns of markets in the the process before those things actually impact markets, if they ever do.
And another thing, kind of somewhat related, is the strength of the U.S. dollar we've seen. Not so much lately, but countries starting to shift away from the U.S. dollar as much as they have in years past. So moving forward, kind of the strength of the U.S. dollar becoming less of the central currency that everyone is trading in. Do you see that materially changing sooner as opposed to later? Has that been more headlines as opposed to, actually happening, on the global economy? Or how would you speak into kind of the strength of the US dollar now and looking forward as well?
Yeah, I'll believe it when I see it. When people say that the US dollar is going to lose its position as really the most dominant currency, I think last time I looked, the vast majority of international transactions were still getting settled in USD. So we'll see if that happens. One thing we do know from the data is there's not persistence in US dollar returns. We know on average that currencies have a return close to zero. They fluctuate year to year, but they don't really have long-term trending for the most part. And if we just categorize years in terms of whether the US dollar went up or down and look at what it did in the next year, there's really no tendency for it to, keep rising if it already rose or to fall again if it recently fell. So, in terms of our strategies, like we tend to leave currency exposure unhedged because we think it's not predictable and because in equities, it's not really contributing much in the way of volatility, even though there can be fluctuations year to year.
Well, I've got one more kind of vague general question for you, but if you had to just look at the last 6 months in a box, here in 2026, what would be kind of the general lesson that you would take away from the last 6 months of the markets as an investor?
I think it's a good reminder that there's stocks outside the U.S. There've been really strong returns from international markets, and investors who got laser focused on the S&P 500 because of its strong returns over the past decade, they might have been thinking, oh, well, am I capturing all of these returns outside the U.S.? So always a good reminder to be globally diversified. And then in EM in particular, and you kind of saw this on one of the slides that showed the weight of the top 10 holdings in EM markets, and it was higher than developed ex-US. And just in so far this year in 2026, EM's had the strongest returns, but 2/3 of the return for an emerging markets portfolio were driven by three stocks. It's like basically a Taiwan and Korea story. In fact, Taiwan and Korea have overtaken China as the biggest countries in emerging markets. So, again, I think that's always a reminder of the importance for diversification because we don't know which companies are going to be driving the performance in the future, and we want to make sure we're holding as many of them as possible.
Yeah, and the one piece I'd add to that is just the strong benefit that you get as an investor. We touched on this earlier, so I won't harp on the point, but with the US market being concentrated in the top names of the market, those top 10 stocks, not only have you had a real strong benefit so far this year and all of last year in terms of the performance of international developed and emerging market stocks, but also it helps to reduce your concentration in these top stocks within the US. So there's been a nice dual benefit of helping you mitigate risk through being more diversified, but also a strong benefit in terms of portfolio returns over the last year and a half.
Hey, Chad, Karen has had her hand raised for a question, so I'm gonna, Karen or Bill, depending on who's behind that, make sure you got a chance to answer your question. It may have been answered because I know you took your hand down, may have been answered in the earlier exchange, but Karen or Bill, if you had a question, here you go. Speak up.
Yes, I wanted to know how the war in Iran is affecting the oil and gas market. It seems like it's artificially reacted to it, and I just wondered what you think is going to happen as it progresses.
Well, we know the oil prices definitely skyrocketed at the start of the war, and I think what you've seen since then is the expectations of the future trajectory of oil prices has fluctuated quite a bit. Like it kind of hinges on the day-to-day news. If there's a hint that this war is coming to a close, then you see that the expectations for future oil prices will fall. If the conflict, or at least the rhetoric around the conflict, heats up, and you see the prices go back up. So it's it looks like over time they'll probably come back down, but I think until then it's reasonable to expect them to stay elevated. And not just oil. I mean, you have a lot of other commodities that are like helium, for example. You get a lot of things that are sourced from the Middle East that have had constrictions around their supply. And when that happens, consumer prices can go up. Certainly, you're seeing the pain at the gas pump. I've never been so cognizant of the fact that my car gets like 12 miles to the gallon as I am right now with oil prices where they are. So, it's certainly painful from that perspective, but I think how it plays out in your investments is a different story. And that's why, I showed that chart earlier of how stock market returns have not been highly correlated with either oil price levels or changes in oil prices.
Awesome. So looks like the questions kind of died down a little bit. So as always, everybody, if you have a question, we didn't get to it, or you're thinking about our time together today, and a question comes up that we weren't able to directly address, that's what we're here for. So always feel free to give us a call, send us an email. Always available to you guys for anything that comes up. But I'll kind of start to wrap us up here and say just thank you again, Wes and Dustin, and our partners at Dimensional for taking the time to be with us today, and all of you attending as well, taking a little bit of time out of your afternoon here just to spend some time with us. So appreciate everyone's time. As always, please reach out to us if there's anything that we can do for you. But appreciate everybody. Hope everybody has a wonderful rest of your day, and we'll talk to you all again here soon. So thank you very much.
Thank you all.
All right. Bye, everybody.